What's any highlight of your weeks for those that are joining us for the first time? Anything that you want us to talk about or bring up while we wait for some more people to come on? What you guys were just watching was from our financial planner, Mark Milan. He did a presentation last week about, what's going on with the market, and I asked them to send me a copy because I like listening, for myself, and I also wanted to see the whole thing with Pantera, and how Pantera was managing what's going on the market. So, how's everybody doing? How's your week? Anything eventful that anybody wants to talk about while we wait, or post in the chat? All right, looks like nobody wants to talk to me today. Okay, no problem. I'm not offended. All right, for me on my end, we continue to look for properties for my son. So the two properties that we had, one of them was at $75,000, but would need about $100,000 of repair work. And so he's asking me, Mommy, what are we going to do? I'm like, Izu, what are you going to do? You're the investor. Do you want to invest in real estate? Do you want to start out rehabbing? Is it a good experience to start out your investing career as a rehabber? What do you guys think? I think that because he's young and just starting out, he should just get a buy and hold rather than going into rehab. The other aspect was like, maybe he needs that experience on, what rehabbing is about to be able to. I mean, summer is out, so he's able to see the whole thing from start to finish. But what do you guys think? What are your thoughts in terms of how you would get a young person started in investing? Would you say they should go for a rehabbing, or that they should get something that's a little bit like something that's completed that doesn't need a lot of work? I agree. Buy and hold, but if you have, yeah. So the realtor that we're working with is a client of ours, Jonathan Rundlet, that we're working with, and he will help with the rehab. I just know that based on my experience of dealing with rehabs in the past, like 20 years ago, I was practicing the rehab strategy, and that's why I went into buy and hold. It always goes over budget. Something always happens and stuff. And I'm like, do you really want to expose a young person to that early where they become jaded and not like real estate versus just start small and then grow? So I do have a good rehabber, a good realtor, but I'm just wondering, is this going to be a good experience for someone that's new? I don't know. Yeah, let him purchase, buy and hold, no rehab yet. I agree. Thank you, Sharon. Yeah, Nicole, buying, yeah, rehab experience would eventually fall back on you. Exactly. So that's the other thing. What's the ARV after rehab? So it's 75. We were going to put an offer for 65, and then it will be 100 rehab. The ARV is sitting at like 199, 200 after rehab because it will be converted to a 3-2. So that's where we are. But in my mind, I'm like, even with the possibility of the built-in equity, do I want to expose him to that? I don't know. So we need to make a decision quickly. But I'm leaning more towards just do a simple buy and hold for now, just to get him started. And then on his own, if he wants to do a rehab later on, he can do that on his own. Oh, let me bring up another aspect. The other thing that I was looking at is, what about mobile homes? What if we invested in like mobile homes? What do we think about maybe doing mobile homes? And my husband thinks that mobile homes is also sophisticated. You are buying properties for the dirt on the ground, which is the land, and mobile homes will not give you that exposure. I was of the opinion that mobile homes are cheaper, and so he's able to at least get his foot in with something cheaper, closer to his school. So we're also looking at that. So that's how my week is going. All right, what else? I would say Buy and hold, but if you do a rehab, I would only do cosmetic. Market feels really shaky right now. Yes, I agree, Anthony. Thank you. David, where rehabs, he may be discouraged and his first deal does not turn out productive, so buy and hold from inception. So I think we're all saying the same thing. So it looks like what my gut feeling is telling me about buy and hold is right. All right, so today we are supposed to be doing like several client interviews. It's not actually where we have clients on, but actually looking at the various client situations to see kind of like how we are approaching things from different perspectives. Okay, let me read one thing before we get started. So mobile homes around here are owned by private equity. Is it like that by you? The mobile home park owned by private equity, but the mobile homes themselves are owned by individuals. So I'm not sure if in the mobile home park, whether you would say private equity now additionally owns the various mobile homes, but I'm not sure. But I know that they own the mobile home park itself, not the actual FF&E, the mobile home that you can move around. So, yeah. All right, so today we're going to look at different things. I do have my other team leads here. I have David on and I have Nicole on. So, David and Nicole, I am going to be putting you guys on the spot, so just get ready. But what I want to discuss is some things that I've seen that just today alone, because there's a lot of conversations that we can have. So the goal in terms of these client interviews is like talking to different clients on various strategies and various tax strategies, real estate strategies, financing strategies that we've just dealt with just today from when we opened at 9 till 3 p.m. So what I'm going to do is to pick three or four of my clients, kind of talk about what's going on. And then I would also ask David them what they've seen today and the clients that they've spoken to or emails. And then if you guys have questions as those things come up, you can discuss that. So let me talk about one client. The one client that we had today, they sent us an email because they owed a lot of money. They're self-employed income. And so the issue that we were having is that with the self-employed income, they have these expenses, but then their lender needs them to have a certain income in order to qualify for a home. And so now we're caught up in the middle of it. Because on one end, if you have the income that the lender says you should have, you are going to owe a lot of taxes. And unfortunately, the taxes that you owe is going to go into the debt to income ratio. On the other end, the client doesn't want to pay that much in taxes. And so they want us to bring down their liability by implementing all the strategies. Now I'm caught up in the middle of it. Who do you want? Do you want to qualify for a home, meaning that you're going to have to amortize certain expenses in order to qualify? Or do you want me to take those deductions, but it might mean that you don't qualify for a house? So that's something that I've had to deal with today with the client in terms of talking to them, that when it comes to years when you have to finance, you have to make a decision on what's important. Is it important that you don't pay as much taxes, therefore you want us to implement a real estate strategy for you? Or you want to be able to qualify for the home, which means that you have to show the income, which means that this year, in qualifying for the income, you will have a tax liability. So it's just understanding that there's kind of like an inverse relationship between financing and tax filing or tax planning. And we usually ask that question in our list of questions because 95% of our clients are real estate investors. Are you getting any kind of financing? If you're getting some type of financing, then yes, it might make sense that in the year that you're getting financing, some costs will have to be amortized to enable you to qualify. So does anybody have any questions about that while I look up one other issue that I want to talk about? Okay, So another thing that we're dealing with today, I'm not sure if you guys heard about it. I am gonna post this on here for those of you that want to look. So apparently, you guys know that during COVID, certain IRS, certain government agencies were not open. So because the IRS agencies were not open, and they were not like they suspended the whole collections during that period, there has now been information coming out that because the IRS is the one that suspended collections during that period, clients should not be responsible for paying any penalty on interest during that time. So that's something that's being discussed, and now the you have to file a claim for a refund by July 10th, 2026. So that's something that came in. A client sent it to us a month ago, sent us a reminder. That's something that we're looking at. It's called the Kwong case, Kwong versus United States, where the case is now still being decided, but it's going to be a matter of, well, you guys are the ones that suspended collections. The clients didn't. Therefore, if you suspended collections, you should not be charging penalty and interest during that time. So that's something that I'm going to be researching, looking at to see whether or not I agree with the position, because the statute of limitation is, this was for 2022 period, which is in 2023 is when the taxes would have been due. So 3 years from then is coming up in a month, where we have to get these refund claims filed for clients that paid penalty and interest during that time. Any questions before we move on that? All right. So another thing that I dealt with today is that we have the issue of moving expenses. When somebody got a job, because of that job that they have, they now have to they collected like a sign-on bonus or relocation bonus. With that relocation bonus, it was included in their W-2. So now they have to pay taxes on it. And paying taxes on it, they're thinking, oh, they should be able to get a deduction for the moving expenses. Unfortunately, the moving expenses were suspended with the TCJA Act. So moving expenses from 2018 to 2025 was suspended. Therefore, you are no longer able to get a deduction for moving expenses. But this has already been included in their relocation bonus. So now they're having to pay taxes on income that they just used for moving. So that's something that we had to, share that news with the client today, that unfortunately they're not able to take a deduction for anything that has to do with moving expenses. All right. David or Nicole, do you have something that has come up today that you want to talk about or even ask about that we can discuss while I continue to look?
I'll go. Um, the last topic you brought up about the client, that was actually one of my team clients, Diana Wazanowski, I believe it was, that sent the article about the taxpayer advocate article. So that's all news to me too. I do need to research about that because I'm not privy to that. So that was good. I'm glad you brought that up.
Okay.
Um,
All right. David, do you have anything?
Yes. So this is actually something that happened. Um, I wouldn't say that it happened, but it was kind of a learning and education process. Um, so I had a client uh that they managed a property for their dad, and he was wondering whether that property needed to be treated like an Airbnb um property, which means that it needs to be reported as a business, or was it going to be reported as a rental property on their return? That's on the Schedule E. So I think it's something that some real estate investors struggle with, being able to distinguish between what's considered active business or rental investment. So in that instance, the question that I asked was if they provided substantial services, similar to what a hotel would do. So substantial services includes like daily cleaning, meals, transportation, laundry. So all those kind of services that are generally also provided by hotels. And in that instance, such activity would be reported as a Schedule C. That's it has to be cleared as a business. But if the services that are limited to those that are normally provided by landlords, like cleaning, maintenance and repair, utilities, trash removals, and all of that, then it needs to be treated as a rental property. So I think it's good that we continue to educate our clients on some of these real estate strategies so that it doesn't become an issue when it's time for them to file their taxes, because there's a distinction or the tax impact at the end of the day is that if it's filed as a business and if there's a net income, then they might be subject to self-employment tax. Whereas if it's treated as a rental property, they will only have to pay the regular income tax based on their tax rate if they have a net income. So that's it on my end. I just wanted to bring that up. In case anybody has any question, I'm also free to provide some more enlightenment on that.
All right, that's good. So thank you, Nicole, and thank you, David. So let's talk a little bit about Airbnb. So as you guys know, or if you're not aware, if you do have an Airbnb property, the requirements are a little bit lax in terms of what's considered passive income or non-passive income, like active rental where you're able to get a deduction. So if you have an Airbnb property, rather than having to meet the real estate professional requirements, which is 750 hours in real estate, that's about 14 hours a week. 750 hours in real estate and not or more time in real estate than in any other active profession. If you meet these two requirements and your AGI is over $150,000, you are able to use these deductions on your tax return. You're able to use it to reduce like wages or other active income that you have. If you don't meet that requirement, even if you're a realtor or you're an investor, any of that stuff, if you don't spend that time and more time in real estate, you're not able to get that deduction. The real estate losses will be suspended until the following year. So those are the rules for regular real estate. Now, when you come to the Airbnb, you only need to put in 100 hours in managing the Airbnb property for you to be able to claim a deduction. So Airbnb rentals are a lot more attractive than the regular long-term rentals. But for the Airbnb to qualify, that's what David was talking about. There's now additional requirements that you have to meet. It has to be an average rental of 7 days or less. Like if you look at the average number of days that the Airbnb was rented for the year, it has to be an average of 7 days or less. You need to be the one that is primarily managing that Airbnb property. And then more importantly, that's what David was referring to. If you provide substantial services, just like a hotel or just like a bed and breakfast, if you're providing those kind of services and is average 7 days or less, you spent at least 100 hours or more managing the rental, then it is considered an active rental property and you are able to take the deductions. We have a lot of our clients who are able to take advantage of this, and we've even gone as far as being able to do cost segregation so that they're able to accelerate the depreciation in the year that they do meet the short-term rental requirement. So that's something to keep in mind in terms of looking at your strategy, looking at whether you're doing long-term strategy or whether you're doing like a short-term strategy, is whether or not you have short-term rental that would qualify you for a deduction. All right, any comments, questions before we move on? All right, so today, again, I got a client who just told me that they got a property under contract in DC. And so one of the things that we're dealing with having the property under contract is how are they going to finance this property? This property is in DC. The cost is $400,000. But they're going to take this property from being a 3-bedroom, 2-bath to a 6-bedroom, 3-bath. And so now, in talking about how they're going to get it financed, one of the things that they looked at is partnering with an investor who has money in their self-directed IRA. So if you have money in your self-directed IRA and you're looking to like make an investment where you get a little bit more than what the market is giving, please reach out. But looking at financing, how you're going to finance a property is very critical for a real estate investor. That's why I usually say, if you're getting huge refunds when you file your taxes, that is not a good strategy because you're giving Uncle Sam free money while you have to, on the other end, figure out how to finance your real estate deals. So getting a refund at the end of the year is not such a good thing. That's why we're doing the annual business meetings. We're doing the year-end tax planning. You don't want to be getting refunds. If you're getting refunds, it's finding a way to like change your withholding or maximizing what it is that you're claiming so you're getting that money up front. So that's besides the point. It's like in terms of making sure that you have money at your disposal. But right now, he has to figure out how to get the money, how much money he has to put down. So if he's going to get it from a private investor, and then whether or not the property will be financed. In looking at whether the property will be financed, he's already done this deal before. So he has other properties that they're going to look at. So they're going to look at his income. They're going to look at how well the other property that he has is doing. Fortunately, that the other property that he has is doing very well. The rent is more than covering the mortgage. So he probably will get qualified. And this is going to take him maybe like 6 to 8 months to get the property rehabbed and then now rented under Section 8. So these are the kind of things that we're dealing with on a daily basis. It's not just filing taxes. Like some people wonder, hey, are you guys open year-round? Yes, this is literally what we're dealing with year-round. And believe it or not, I have 100 emails that I have not attended to today because usually I start dealing with my emails in full force at the end of the day. While I have appointments talking to staff, I'm not dealing with my emails. But I'm excited because this client has been looking for a property. It's been almost a year that they've been looking for a property in DC and could not find a good one. So getting this one under contract is a huge, 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 huge step that they've taken to acquire this property. All right, let's see. We have a question. When you do accelerated depreciation, what things should you consider when selling? Thinking specifically about recapture depreciation. Okay, that's a good point because that's something that comes up a lot. We have a lot of clients that make a mistake when they're calculating what their capital gain is. When you're looking at your capital gain on a property, most of the time you're looking at how much cash that you got at closing. The money that you got at closing has nothing to do with the taxes that you're going to pay on your capital gains, because capital gains does not look at the proceeds that the seller got at closing. So let's look at it a different way. Like if you refinanced your property, let's say 5 years ago, and you took money out. So you got money out at refinance, and then now you've sold the property, so you got less. Remember that when you refinanced and took that money out, you did not pay taxes, which, by the way, is a very good strategy for getting money and not having to pay the taxes. But then, secondly, if you've been claiming depreciation on the property over the years and you've been getting as a deduction, when you sell the property, you now have to recoup all of that depreciation. So the depreciation that you claimed over the years, in the year that you sell that property, all that depreciation has to be recouped. So yes, you will have recaptured depreciation, but what we're looking at is the time value of money. Is it better to get $50,000 deduction in year 1, and in year 10 you now have to recoup it when you sell the property, or to say, hey, I don't want to get the bonus depreciation, or I don't want to do the cost segregation because in year 10 when I sell I have to recoup it? You have to look at the time value. We are of the opinion that you should do long-term buy and hold on your property. So if it's long-term buy and hold, if you take advantage of cost segregation or bonus depreciation in the first year, you're going to get a benefit of that depreciation for a long time, especially if that money is reinvested before you now have to pay it back to the IRS. So yes, you should consider that when selling, but that is not, like, for us, because most of our clients are like long-term buy and hold, that's not a reason not to do the cost segregation and have some money in your pocket right now. Any other questions? Another issue that came up was the issue of inheriting property. So we have a client where they inherited property, but they inherited property not directly from their parent, but from a grandparent. And so when that property was inherited from the parent, it is them and their uncle that inherited the property. So now the issue that we have to deal with is, what is the cost basis of this property that is now inherited between a grandchild and a child of the deceased? We're going to have to split out the cost basis. For the children, for the grandchildren, because they are direct lineal descendants of the parent, the grandparent that passed, they will get that property at fair market value. But for the portion of the property that they inherited from their uncle, they're going to get that property at their uncle's basis, and the uncle's basis would be the basis that he got, the fair market value that he got when the parent passed. So now we have two separate things going on here. We have the children who are inheriting the property from their parent, the parent from the grandparent. All of that is going to be fair market value. So we're talking about what, 10 people? So 90% of the cost basis would be based on fair market value. There's a 10% that they got from their uncle is going to be based on his cost basis, and his cost basis is going to be based on the fair market value of his parent, his mom, at the time of his mom's passing. So sometimes it becomes complicated because now you have to do a split out of that original asset in order to properly allocate the fair market value based on, whoever passed. So interesting stuff that we end up doing on a regular basis. All right. Nicole or David, do you guys have anything else? Does anybody have any questions while I continue to look here for another situation?
I had a situation come up today regarding mortgage limits. Regarding a client's primary home, and they also purchased a second home last year. So this was a new task for me as far as figuring out the interest portion that could be claimed. There's a limitation cap which the clients exceeded. So now we have to calculate how much of the portion is allowed to be claimed. So I don't know if anyone else incurred anything like that. I'm sure you guys probably have over the years.
Yeah, so that's important. So let's talk about mortgage interest limit. So if you purchase property that the mortgage is over $750,000, unfortunately, the interest is limited to what is attributed to the $750,000. So let me tell you what I did with a client before. So we had a client who I think their value was almost $1 million, $1,000,001. But what happened was that the $200,000 of the 1 million, they used that to purchase an investment property. So they had a primary mortgage, then they had a second mortgage. Putting them together, 1 million is over the $750,000 limit. But within that, the line of credit that they got, 200,000 of that was used to purchase another rental property. So what we did was we allocated $200,000 of the $1.1 million. We traced it to the rental property, so they were able to get the interest deduction on the rental property. Then they were now left with 900,000, but they could only claim 750,000. So 150,000 of the 1.1 million, they were not able to get that interest deduction. So unfortunately, that interest is not even where it's suspended or anything. They're not able to get it because it's subject to the limit. So in essence, they were able to get the interest deduction that's attributed to 950,000 of the 1.1 million. So that's something to keep in mind when you're getting properties. If you get properties where the mortgage is going to be over 750,000, just keep in mind that the mortgage interest is going to be limited. So thank you, Nicole, for bringing that up. David, do you have something?
Not really, but this pertains specifically to those clients or taxpayers that receive or that are expecting to receive a refund when they file. So you don't want to experience delays because the IRS, they would now require that you provide your account details. That's if the return is filed without the direct deposit information, they will now require that you I think there's a website. They will send you a letter to use a website to provide the account details. So that might actually entail additional delays in collecting your refund from the government. So if you don't want to experience such delays in receiving your 2025 refund, you're better off just providing your bank account and routing number so that you can get a direct deposit of that refund. I don't think that they still send paper checks.
Yeah.
I think that they are trying to do away with that effective 2025 tax year. I think some people mentioned that they're still sending checks, but I've not really confirmed. So I just wanted to throw that out there. That's it for me.
Yeah, they did away with it in November of last year. So the IRS is no longer sending paper checks for anything that is filed effective the 2025 tax year. So if you don't provide, like we have some clients that are still insisting, we're not going to give you we're not going to give you your direct deposit information. We want to still get a check because we don't want the IRS having access to our bank accounts. We understand all that. However, your refund is going to be delayed. And what I'm understanding is that if you don't provide the direct deposit information, they end up sending you a card, like a debit card, where the money is, kind of like the Cash App card or whatever, something like that, where they will now put the refund on the card because they have stopped sending paper checks. Okay. This here, the other thing that I'm looking at here came in today, but this came in from another accountant that we are supporting. They have a client that has not filed taxes since 2016. So you have what? Almost 9 years worth of taxes to file. Here is how I handle prior year filings. I only worry about the last 5 years. I would not necessarily go back to file 2016 through 2020, maybe 2021 through 2025, except the IRS demands that it be filed. So let me bring up something that's very, very, very important for everybody to know as a result of this. This is something, I'm going to put it in the chat because this is something that you need to be aware of. It is called the CSED date. The CSED date is the date when the IRS can no longer enforce collection actions against the taxpayer. That is 10 years. So if you owe in 2020, if you file 2025 and 2026 and you owe taxes, the IRS can enforce collection action against you up until 2036. If after 2036 they have not been able to collect, they can no longer come after you. So because we are in 2025, well, we're in 2026, if I'm looking 10 years back, I'm looking at a return that was filed in 2016. Anything after 2016, the IRS can no longer come after the taxpayer. Therefore, I would not even bother filing that 2016 tax return. Well, another strategy that we use to help clients reduce their liability is, let's assume that you go ahead and you file the 2017 through 2020 anyway. First of all, if you're getting a refund, you're not going to get it. You had 3 years to file. They're not going to give you a refund. But if you owe and the amount is over a certain limit, then now they can still enforce collection actions on you. But guess what? 2017 taxes were due in 2028, right? Sorry, 2017 taxes were due in 2018. 10 years from 2018 is 2028. That means that even if you filed a 2017 tax return, it was due 2018, by 2028, if you owe, they can no longer enforce collection action against you. That means that if you waited and made your minimum payment up until 2028, you no longer will get any collection enforcement from the IRS. So one of the things that we advise people to do when they're owing prior year taxes is to set up a payment plan, what we call a payment plan installment agreement, where they determine the minimum that you need to pay every year. You just pay that amount every year until the CSED date comes, and that liability will drop off. You no longer will need to make that payment. So one of the questions that I asked the CPA that reached out, I'm like, why are you filing 2016 when the CSED date has passed? So I'm waiting to hear back from them, but that is a strategy to keep in mind. Okay. Any questions? Well, again, like I said, these are, everything I'm telling you happened today, believe it or not. So does anybody have any questions while I continue to look at my emails and see some responses that I provided today? Okay. So another one that we are dealing with is with parents, with the passing of parents. Of course, when the parents pass, you have estate tax returns that need to file. You have their final returns that need to be filed. In this case, the issue of like pulling their transcripts, what it was that they filed before, if they had any properties, determining the fair market value on the date of their death. So there's all these things that need to be done. What the advice that I usually give my clients is, when death has happened, like we have clients where, either they lose a spouse or they lose a child or they lose a parent. Emotionally, that's already a lot to deal with. What I tell my clients to do is when it comes to the issue of filing like estate returns or whatever, just pace yourself. You don't have to get everything done at the same time. You can just lay it out. Like this client that we have, they now have 3 filings that need to be done. They have to file their parents' tax returns 2 years, and they have the 2 separate estate returns that need to be filed. So pace it out and say, okay, I'm going to start with 1, get that done, then get the next one done, then get the next one done. Just remember that if they're getting refunds, you have 3 years to file. So yes, even though the 2025 return was due in 2026, if they've traditionally gotten refunds, you have till 2029 to file the 2025 tax return. It all does not have to be done in 1 year. This is also the reason why if you're in the wealth building program, which most of you here are, you need to understand that April 15th really doesn't mean anything in the grand scheme of things, because guess what? If you're getting a refund, April 15th doesn't matter to you. You have 3 years to file. So April 15, 2026, which is the due date for a 2025 return, really doesn't matter. You have 3 years to file it. You have up till April 15th, 2029 to file if you're getting a refund, to get the refund. We have clients who their 2022 taxes that was due in 2023, we just now mail them out before April 15th of 2026 because they have 3 years to file, right? So I've dealt with everybody that's getting a refund. If you're owing, extending the time to file does not extend the time to pay. So if you're owing and you're not going to make a payment by April 15th, filing an extension does not do anything for you. So that means that if you're going to owe the IRS or you're going to owe the state and you're not making a payment by April 15th, you might as well forget it. You're still going to be hit with penalties and interest, which is why we educate our clients in knowing that a lot of times the whole rushing to get your taxes filed by April 15th is not always the best, even though the IRS has created this fear that makes people want to rush. A lot of times people end up making mistakes. You're dealing with CPAs that are exhausted trying to meet that deadline. But in the grand scheme of things, that date really doesn't mean anything. If you're getting a refund, you can wait a week or 2 to file it. You don't have to rush with everybody. Work with your CPA and give them enough time to look at your returns. You see how I have time to look at the returns? I have time to talk to you guys. January through April, well, February 15th to April 15th, we don't have that kind of time because we're having to look at too many returns. So April 15th really doesn't mean anything in the grand scheme of things, which is why we also advise our clients do year-end tax planning, because April 15th is your tax filing deadline, but December 31st is really your tax savings deadline. So whatever you don't put in place between now and December, you're pretty much just reporting. So if you've done year-end tax planning, there's no need to rush to get your return filed by April 15th. It's just fear tactics that the IRS has created, and a lot of people are falling for it. But what happens is now you're not doing tax planning, you're dealing more with compliance, which also has its own issues because certain things could be missed when you're just trying to get to compliance and not really deal with planning. All right, any questions before we move on? I'm still looking at the emails to see what I've gotten today. Okay, so this here, okay, this one is very important. I think you guys need to know this. A lot of times when you like go to all these what do you call it, conferences and gurus or TikTok, they're always talking about, especially for investors, real estate investors, oh, claim, like everybody automatically thinks claim a deduction, take this deduction, take that deduction, because automatically you think that taking a deduction means getting a larger refund, and that's not always the case. So this client that we dealt with this morning, what we were doing was calculating what we call wasted deductions. What is wasted deduction? A wasted deduction is a deduction that you give us to claim, and yes, we claim it, but it's not really doing anything for you on your taxes. I'm sure some of you are shocked about that. Like, because there's some deductions that it doesn't matter how much you claim it or put it on your return, it's not going to change your liability. It's not going to change your refund. That is why we therefore call it wasted deductions. So part of the strategy that we implement is that we don't want our clients having too many wasted deductions. So what we did for this client is, because when I reviewed the return, I looked at 3 years and I'm like, wait a minute, they have a wasted deduction in 2025. Do we really need to waste that deduction? Or is there a way that we can preserve that deduction and use it in later years? So what we did was, when I started reviewing, I noticed that because they have like 16 rental properties, one of the rental properties had huge repairs, and those repairs were expensed. However, you could take the position that some of those repairs could be depreciated as improvements. And so what we did is, if they don't need that repair deduction, there's no need for us to be aggressive and claim that deduction. That deduction can be depreciated and spread over 27 and a half years. It doesn't change their refund, right? So it doesn't change their refund, but we are now able to, push that deduction into a later year where it's going to make a difference for them. So when you are preparing your return, or when you're giving us deductions, just make sure that you keep in mind that not every deduction is created equal. There's some deductions that end up being wasted because you're claiming it on the return, but it's not going to reduce your liability, or it's not going to change your refund. It's working to see how much of those expenses can be pushed into later years, and then you're able to claim it in later years. The last one that I'm going to talk about today is where a client was advised, because usually when you're dealing with financial planners, they'll suggest, hey, do a Roth IRA conversion, do a Roth contribution, don't do a solo K and all that, which we understand. What I had to tell the client is, this year, 2025, you're in a higher tax bracket. So yes, the financial planner has told you that you should do a backdoor Roth contribution. I did not support it. I said, rather than doing a backdoor Roth contribution, why don't you make a solo K contribution in 2025 where your AGI is higher, and then next year when your AGI is lower, you can do the backdoor Roth in that year. But the only reason why I was able to speak to it, they sent an email, right? So in developing a relationship with your accountant, as we work through these things, I know sometimes we don't always respond on time. You can see why today. Like, I'm literally looking, I have 93 emails that I got to get through today. So it's not because we don't want to respond, but it's also making sure that every client that we're dealing with, that we are giving them adequate services. But it's better that you send an email and we get to it, even if it's a week or two later. If it's an emergency, you let us know. Then not to say anything at all. You make a mistake, or you make a decision, and now you have to come back and we're trying to fix it and we don't. The last one, I got an email today. We have a client that owes almost $50,000 in taxes. Very sad, because they sold stocks in order to do major repairs, because they have this very crazy tenant who trashed their property. And so it was going to cost them $150,000 to rehab the property. They didn't have that cash, but they had all this money sitting in stocks. They sold the stocks, did the rehab. Guess what? They now have these huge taxes now that they have to pay because the selling of the stocks put them over the limit of the $150,000 AGI. Therefore, all of the losses that they had in the property that they rehabbed, they're not able to claim it this year. I didn't know any of that. I'm finding that out during tax filing. However, if there's something that was discussed prior where the person says, hey, I'm thinking about selling, I'm thinking about selling some stocks because this is what happened with, we would have been able to tell them, hey, because automatically as a client in your world, you're thinking, sell the stocks, use the proceeds from the stocks to do the rehab. It's a wash. It didn't happen that way. Sell the stocks, you have capital gains. Do the rehab, you have losses. You can't claim it. You're not a real estate professional. You didn't spend up to 750 hours as a real estate investor. Unfortunately, those losses are now suspended. Now you have this huge liability. But had we spoken about it before the decision was made, there could have been a way to handle it. The way that I handled it with another client who had a similar situation, we told them to borrow. So they had a previous job where they had a retirement account. We had them set up a solo 401k under the business, transferred the money from that retirement account into the business account, and then borrowed from that to do some of the rehab so that the money that they took out from the retirement account was now less. By doing that, they slashed their tax liability by more than 70%. But if they just said, I'm just going to go take this money out of the retirement account and then I'm going to use it to do all this work and buying this additional property because it's going to be a wash, they would have been caught, during taxes where now they have a huge liability that they were not anticipating. All right, I know I've talked a lot. We have about 3 minutes to go. Tell me, what is your takeaway? Do you have any questions as we get ready to wrap up? We have one more meeting coming up next week. If you have any topic that you want us to talk about, let me know. But I will pause now to see if anybody has a general question or something that you want to bring up before we round up. Oh, let me send you guys this link. I did tell you guys that my daughter is going to be a panelist with Rick Ross. That's a big thing that's coming up for us June 27th at National Harbor. If you have a young adult between the ages of 19 through 29 and you want them to attend, we will be giving away raffle tickets for them to be able to attend. It's important that we continue to create legacy for the young people. So please reach out to us and let us know so we can get them on the list. We're developing a list now for the young adults, 19 to 29, who want to attend this event and don't want to get a free ticket to be able to attend. Any questions? Any comments?
Congrats to Ure.
Thank you. All right. If we don't have, did somebody want to say something? Okay. All right. If we don't have anything else, I would like to thank you all for coming to our TED Talk today. I will stop this recording. And